Folks, welcome back to the Taylor Tax Show, the podcast that helps highly paid, highly taxed, high profile, high net worth, and ultra high net worth taxpayers save a bunch on taxes legally. I'm Terrence Taylor, the co founder of Taylor Tax, and I'm an enrolled agent. This is my partner in crime, Big Al Darnell Jr. Say, what's up, Big Al?
What's going on, everybody? I'm Big Al, and I love my mama.
Big Al is also an enrolled agent and a co-founder in Taylor Tax. So today's topic, episode 35, is using life insurance to pay off debt. Big Al, did you ever imagine in your wildest dreams that you could use life insurance to pay off debt?
What you?
No, because I've always thought that life insurance was just for that thing called a death benefit. But folks, today we're going to keep it simple and we're going to keep it straightforward. We'll illustrate for you how this is possible and talk about one or two benefits for those who are considering it. All right, Big Al, let's just jump right in.
Yes,
So the first thing to note is you must have the right type of life insurance to be able to use this strategy to pay off your debt. Cannot be term life insurance because term life insurance doesn't have something called cash value and doesn't have a feature where you can borrow against the cash value of the policy. So it must be a type of permanent life insurance that has cash value. So that's the first thing, Big Al, right? And the second aspect is the insurance policy that you use to pay off your debt must have enough cash value, obviously, for you to borrow against it and to be able to pay off a set amount. So let's, for argument's sake, Big Al, say someone is looking at a $10,000 debt. They must have enough cash value in their life insurance policy where they can borrow up to 10,000 to be able to pay off that debt all at once, or perhaps a portion of the 10,000 to pay off that debt over time. Anything you want to add at this point?
this is just the basics of it. I also wanted to express the comparison of the net interest rate that you're going to be paying, making sure that whatever interest you're being charged to borrow money from your cash value policy must be a lot less or less than the interest that you're trying to use it to pay off in order for any of this to make sense.
Absolutely correct. And then the second aspect to consider is if you are already in debt, then what type of life insurance, cash value life insurance policy you should use to be able to pay off the debt. So when I first got into the insurance space, Big Al, and even when we first spoke about doing $1 Million Baby for Your Kids, we did another episode on that, folks. So if you want to check that out, feel free to check that out. We understood that you had to have a cash value policy such as Index Universal Life, and you had to have held it for a certain number of years before it made sense for you to start tapping into the policy loans via the cash value. Well, it turns out that there's an insurer out there, who shall remain nameless for compliance reasons, that has a product where you can put money into the product, Big Al, and it's called a whole life index policy, so WLI, and you can take out a cash value loan on up to 80% of the cash value within 30 days. What do you think about this?
To be able to do it that quickly.
Right? Yeah. So I'm getting low energy from Big Al, but that, folks, to be fair to Big Al, he is worried about his internet bandwidth and, he's sitting in his truck. So that has something to do with it. Not that y'all haven't noticed that he's not in his usual spot, but Thanksgiving holidays, and hey, we're working hard for y'all, trying to make sure that we get this podcast done. So, all right, Big Al, that is a game changer to be able to put in money. So let's use this example again of someone who owes 10,000. If you're able to put in enough money to have cash value to borrow against the cash value up to 10,000, right? So the implication is you have to have more than 10,000, right? Then you can begin to pay off that loan. Something you want to add?
Yeah, definitely. So here's the thing to consider. I'm not sure if I know you've heard of it before, but I'm not sure of how many of our listeners have heard of it before. But the concept of infinite banking. All right, this concept of infinite banking has to do with using life insurance or whole life insurance to pay off your debt. And what I was talking about before about the difference in interest rates that you're paying, most debt, let's just say if we're talking about, let's just say the lowest type of debt might be your mortgage. That's still right now at 6 to 7%. Then let's slip into a car interest. Now we're talking about maybe 12 to 15%. We're talking about student loans. That's 7 to 15%. Then we're talking about credit cards. We're thinking 25% to up to the sky, 60%, so on and so forth. And then of course any types of other hard money loans or I don't know, title loan debt, so on and so forth. Title loan debt is going to be much higher. We're talking about 400%. So if you can borrow from your policy, let's just say around prime rates of 3.5 to 4.5, 5%, then please believe it's the better option to pay these things off. Now, what we're talking about is from a cash flow perspective. So think about it like this. One concept has it this way, where you literally download your entire paycheck into your policy because it's more of a because when it's more of what's the type where it's available when you pay it off, and then when you use
Revolver.
it up, it's revolving. Yeah, it's more kind of like a revolving optionality to it, so that if your entire paycheck goes into making up or paying off the balance, then what you're doing is you're maximizing the lower interest rate of your payments, interest that you're being charged by the insurance policy, and then utilizing it to pay off the larger amounts and to pay for every other aspect of your lifestyle if you so choose. And now you're pretty much shifting all of your high interest debt into a low interest debt that's being paid off customarily with every 2 weeks, every 2 weeks with every paycheck. All right. And that's how you get to accelerate it, because what we're doing now is we're balancing the act of with a lot of these interest payments. If you've looked at an amortization chart, could you tell them what an amortization table is, right quick, Terrence?
Yeah, so when you normally have debt, you could ask for this. You could ask the lender to give you a chart to show how the payoff happens over time. And what it shows is the composition of the payoff, principal versus interest in the total. And what you will tend to observe if you haven't already done this is, and I'm sure for our audience you have, right? But for those who may not have done this, you see that in the early days, early years of a loan. So, if we're talking about the 10,000 car loan, for argument's sake. Would it be great if we could still get those, Big Al? The first few years, the bulk of that payment is going to be made up of the interest. So over time, it will show you how the amount of principal versus interest changes, where eventually in the later years, most of the payoff is like most of the payments you make is applied to the principal, and then eventually you pay off the loan. So that's what that is.
Correct. The reason, and thanks, that the perfect explanation. The reason I wanted you to explain that is because the reason that this is such a powerful tool is because even if you're making $1,000 a month payments, $10,000 a month payments, what you're doing is you're allowing yourself to write down or pay off the interest portion a lot quicker, which is why your loan is so much longer. It takes so much longer to write off your loan, to pay off your loan if you're making just random regular payments. Because what happens is if the payment is $500 and you're making $1,000 payment, that extra $500 is going to be applied to the principal, which reduces the loan and thereby reduces the amount of interest that you're paying on paying for every single month. It's just it's an exponential benefit to anybody that uses this particular strategy in order to reduce their debt. They can turn 30-year loans into 15-year loans. They can turn 15-year loans into 3.5, 4-year loans. So yeah, it's an excellent strategy, and literally all you're doing is just making one extra stop for your payments. Instead of taking the money and putting it on the loan, you're making sure that the money goes into your cash value policy, and then taking it from your policy to pay on the loan. And literally that situation will have exponentially great effects on your overall finances. Plus you get the benefit of the death benefit as well. And if there are any living benefits that you would get had you not had that policy in the first place. We didn't even talk about that. We're just talking about the exponential speed that you can pay off the debt and the reduced interest you'll be paying on this debt. But if we throw on top of that the death benefit and potentially living benefits, depending on the riders that you have on this whole life policy, it can kill two or three birds with one stone.
So, folks, I'm so glad I mentioned to Big Al that his energy was not the energy I was used to because he came alive. I love him. And he just dropped so many nuggets on that one. So I just recap because Big Al, you took us home on that, right? Like there might be one or two other things to add, but here's what he brought home for me, and I hope you caught it as well, folks. So the beautiful thing is, many of you may be asking, like, where do I get the money from? Like, if I already own 10,000, what do you mean, like, drop enough money to be able to borrow 10,000? Well, Big Al has already shared that there are strategies for how you get money into the policy over time, right? So even that money that you're using now to make the payments on the 10,000 loan, for example, you put that into your whole life index policy if you're trying to get the money out in 30 days. And that helps you to build up cash value quickly that you can start paying. So in that scenario, that's one way where you can get money into the policy to be able to pay this off quickly is you use money that you may have in other accounts that currently are not actually as tax advantage. So many people have savings in the bank, and Big Al, I'm guilty of this. Right? You owe a lot in debt, but you still got like thousands of dollars saved up in your savings account. Drop those thousands of dollars in the savings account into your IUL, which then into your whole life index policy, which then allows you to be able to borrow more. So that is critical. So where do we find the money? So there are all kinds of strategies that come to mind in terms of where we can find the money. Anyone interested in this and pursuing it, get in touch with Terrence at tailoredtax.ai. So TERRENCE at TAYLOREDTAX.ai or Big Al at tailoredtax.ai. And we'll be more than happy to share those strategies with you in different ways. But even more powerful, Big Al, the neutron bomb potentially of this strategy is the accelerated payoff, understanding this amortization concept. So if you are able, exactly, right, to borrow from a whole life index policy, if you're trying to get the money quickly, like 30 days, or an index universal life policy, if you've planned ahead and you are able to start tapping the cash value in your IULs, you can pay off the debt much quicker. And he's already mentioned the types of debts, which is a third benefit and another potential that you could use with this strategy. You can be paying off things like your car note, things like your credit card, things like your student loans, things like your mortgage. And then he went all the way up to things like title loans. And what we know is that each of these loans tend to have really high interest rates. Whereas when you borrow against your policy using policy loans, you are able to withdraw this money tax free and at an interest rate of around 4.5 to 5.5%, much lower than you would get anywhere else. So, folks, we could continue because this is such a powerful strategy, but we just wanted to bring that to you today. And Big Al, any closing thoughts?
Check out Tax Strategies GPT on the OpenAI website and make sure that you reach out to us about any specific tailored tax strategies that you want to engage in.
Okay, folks, thank you so much for spending time with us and see you soon.
Cheers.